Welcome to Bar Chart's series of educational webinars designed to enlighten you on a variety of trading ideas and concepts to inform you of the features and tools Bar Chart provides related to these concepts and offer you some traders' insight to help make a more informed trading decision. Today's session, shedding light on naked puts. Now, a put option gives the owner the right to sell a specific asset at a specific price up to a specific time. A put seller becomes obligated to purchase an asset at a specific price over the same period of time. Now, the owner or the put buyer pays a premium for the right to sell, and the seller of the put receives or collects that premium to take on the risk if the underlying asset price falls from transaction to expiration. The naked put option strategy entails the options trader selling a put, giving up the right to sell in order to collect a risk premium and take on that obligation to purchase. Now, the naked put seller benefits from the trade if the underlying asset price remains relatively the same or appreciates over the period of the option and becomes under risk if it falls in price. The naked put strategy is defined as an income strategy because if successful, the put seller keeps the premium without taking ownership of the underlying. However, some traders use naked put strategies to discount an entry price in the hopes of ownership. Hello, everyone. My name is John Rowland, Bar Chart's Senior Market Strategist. And in today's session, we're going to just concentrate on the income aspect of the naked put strategy, though I will touch briefly on the discounting to ownership side of the trade. Now, in both cases, we're going to look at Bar Chart's naked put screener, its filters, their purpose, and how they can be used in the selection of the right combination of strike, time, premium, probability, and risk. Now, before we get to all of that, please welcome our moderator and Bar Chart's project director, Gene Baker. Hello, Gene.
Good afternoon, Jen. How are you doing?
I am doing great. And how are you doing?
I'm fine. Yeah, fine.
Just fine?
Good Wednesday. Yeah, good Wednesday here in Chicago.
Awesome. Is it getting to be fall like in
It's
Chicago?
cooled off a bit, but it's still very nice.
Okay. So I want to give you some kudos, Gina, because I know you've been really busy building our new learning center library for options, and that you and our crack staff have been really doing a great job on it. So hopefully we'll get a chance to do a little showcasing, especially if you're new to options. This is a great place to start your education on options. So you ready to get started, Gene?
Yeah, and John, why don't you at some point, maybe toward the end, show them exactly where they can access this options learning center.
I plan on doing that.
Okay, great. Okay. Thank you.
But today's session, Gene, is really going to be more about application and execution and this balance between reward and risk. All right, just to remind you that today's session is for educational purposes only, and decisions to buy, sell, or hold or trade securities, commodities, or other investments involves risk and is best made with the advice of a qualified financial professional. And options trading is not for everyone, and naked puts, my friends, has the potential to create significant losses. And under no circumstances shall we be liable for any losses or damage that you or anyone incurs as a result of any trading or investment activity that you or anyone engages in based on the information or material that you receive through barchart.com and our services. Okay, so let's just dive right into it. And so here I've gone to the options page, and I've opened up the naked puts. And so again, as I mentioned in the opening, the naked put strategy is we try to capture premium by selling options, and we expect the underlying security to remain stable or to increase. Now, the risk is if that underlying price depreciates, and we could be forced to buy. Now, if you're new to options, or this is something you want a little bit more information about, this is what Gene was talking about. If you click here, it says learn more. This is going to take you to, which is a new feature on bar chart, which I'm really excited about, is our options learning center. And here what you're going to get is more of a textbook definition. And not only that, but you're going to get a lot of details about just the mechanics of, this particular strategy. And not only do you get details, but you get trade examples and certain scenarios or outcomes, as well as a link to a video on our YouTube page that will help you through this process. Where are we? And if you want something that's a little bit more advanced, or just kind of building on what we're going to learn today, then you would just click this one that says watch the webinar. And this is a webinar I did about a year ago. And these are a little bit more advanced ideas when using the naked put strategy. All right, so the naked put screener screens across markets and is looking for candidates based on some predetermined inputs, or as we call them, filters. And these range from days to expiration to out of the money probability. Now, these are just jumping off points, and we'll look at how we can modify them, change them, or even add different filters. But some of these are intentionally left blank, where others are designed to narrow the field of candidates, i.e. a great example here is here's security type, where we're just screening on stocks. So we could change this to just screen for ETFs. So what I want to do is I want to walk through some of these filters. Well, let's look through all these filters. But if you want, again, a little bit more detail, you can click on the help question mark on the top. And we're going to look at what is called the views and the filters that are on the different views. So just stick with me on this one. All right, so what are first one? Symbol. Well, we know this is just the symbol of the underlying asset. Price. What is the last price this symbol traded at? The expiration date. When does that option expire? Now, there is a good point here to be learned, is that our filter for our option screener uses an expiration of 0 to 60 days. And I also want you to notice that we have it clicked on the monthlies. Now, the idea here is that institutional traders tend to trade more monthly expirations than they do weeklies. And that means that there will be more activity, liquidity, and volume, which will be helpful for us because it will narrow the bid and ask. And that liquidity will make it a lot easier for us to get in and out. There's also another aspect to this, is that we're talking about time, and we're going to learn about theta. And there's this balance between the amount of time we give the option buyer and the premium that they're willing to pay. Now, it doesn't mean we can't use weekly options for our process. It's just that weekly options don't really become very active until about a week from their expiration. And so they also are lower in volume and liquidity. And as I get to within a week of expiration, weekly options tend to have very low premiums. So strike is the next one. So the strike is just the price of the option that it could be exercised, or what the transaction price between the buyers and seller if that option was executed. Moneyness is just a relationship between last price and the strike price. Notice that here, because we're probably looking at out of the money options below current price, you're going to have a negative or red value. The bid is the price to sell now. What is the best bid for that option? Now, all of our calculations on this data table do revolve around the value of the bid. But I'm going to give you a little trader's advice here and a little trader's insight. So the calculation is based on the bid price, but we don't have to take that bid price, right? We maybe could wait on the day that we're going to execute this type of trade. We might wait for, let's say, an intraday price falling, right? Then the put might become a little bit more expensive. Or I might do something that's called middle, where I'll put my offer to sell, somewhere in between the bid and the ask. Now, why do I tell you this? Well, there's two reasons. First of all, just a few pennies off of the bid can make a large, dramatic change in your potential return. And market makers, who are probably most likely the ones that are going to be in the opposite side of your trade, will give you a bid price that for them, based on how they manage risk and their mechanics, is where they can lock in profits immediately as you sell that. So you're actually giving away just maybe a couple pennies of profit to sell on the bid. But again, as our process today, it's about the calculations as we move forward. Now, the bid to break even right here is just the strike price minus the bid. Now, the bid is, again, that premium that we're going to receive. The break even BE percentage, now that is how far price has to fall from current price in order to reach the price of our break even. Now, we're going to talk about something called downside protection in terms of a probability, but this is how we can turn it into an absolute value, a percentage value. So in this case here, DJT, in order for price to go down to this 1719 bid price, which is our break-even price, it would be almost a 90% from current value. So volume and open interest. So in this case, these are definitely tools that we're going to look at, but I just want to mention here before we move on that all the data on our options data pages are delayed 15 minutes. So your volume and open interest will be delayed for about 15 minutes. Now, when we talk about open interest, well, that's how many contract positions have been opened and have yet to be closed. And again, the theory here is that the larger amount of open interest, the greater the liquidity. Now, I know somebody's going to ask me, well, what would be a threshold of open interest that you would be looking at? And so I'm just going to be kind of conservative. I would say somewhere between 500 and 1,000. IV, or implied volatility of the option strike over the time of the option. A delta, this is a measurement of change for every dollar change of the underlying. So that is a value between 0 and 1. And so if you think about it, and again, in this case of DJT, if the stock changes by $1, then the options would change by a value of 0.209, or this is cents, or 20 cents for every dollar change in the option. Now, delta can also be used as a value of a chance that the strike will finish at the money. Again, we can look at this as a potential probability and we would times that by 100. So in this case, there's a 20% probability that DJT will be trading $10 on November 15th, or about a 1 in 5 chance. So I think a better tool for probability we're going to use is the out of the money probability. And this is actually the opposite of delta. This is the chance that price will not finish at the money. And you see that is in a percentage value. So then we have potential return. This is just the bid divided by the strike minus the bid, our break even. And it's in a percentage value. And then we have annual return. And this is where we just take the potential return and we analyze it over 365 days. Now, we're not going to hold an option for 365 days because this strategy, we're going to have an expiration probably within 60 days. But it's a measuring stick for comparison when we do our analysis. Now, there are other views in our screener. We have dividends and earnings. Now, the importance here is that, first of all, we know that earnings can have a large effect on options. So, for instance, in this one, the NFE, right, we have an option that expires on 11/15, but the earnings comes out on 11/13. For sure, we know that earnings will have an effect on the price of the stock, and that will have a greater impact on these puts. Dividends as well. The market will discount the stock price when we have an ex-dividend event. And so in that case, let's say we have a $50 stock that pays a dollar dividend, then the stock price will drop to $49. That effect will actually raise the price of puts. But we also have the options view. Now, the option view here, again, a lot of the same inputs that we just talked about, but here's where you can find your Greeks as well as implied volatility. Now, we might look at theta as something that is important for us because the naked put strategy, we're really long decay, or what we call positive theta. We want that option to decrease in value every day, and all things being equal, theta will tell us how much that option will lose in value. Now we have filter, and a filter view is going to give us the results of our filters. Now, one of the benefits of being a premium member is I can create custom views or custom screeners, and I can change some of these or add some additional filters. So if I make any types of changes, then those results will be found in the filter view. So let's do this. Yeah, there we go. So I have created a screener called Naked Puts for today's webinar, and don't worry, you will have an opportunity to have that in our file that you can look at it. And if I look under the filter view, I can see that, some of them I haven't changed, but maybe I've changed the parameters, but you can see I added something called signal. We'll get back to that in a little bit later. Okay, let's go back to our main page, and let's talk about a little philosophy of the trade and the mechanics of naked puts versus something called cash secured puts. Now let's talk about the latter first. A cash secured put means that we put up the value of the stock of the underlying minus the premium collected. In the case, the option that we sold becomes in the money and is assigned. In other words, our put option buyer exercises that right to sell to us. Now, you can imagine there might be a stock, for instance, like Meta that trades $560. One option, right? One option represents 100 shares. Well, we would be required to put up collateral of about $56,000. That's certainly a lot of collateral. Now, naked put strategy assumes that we're trading on margin, and where depending on your broker, right? Every broker will have different margin rules. We'll only have to put up a portion of the collateral of a cash secured put. Now, in general, again, don't hold me to this, but in general, it's usually about 20% of the equity price plus the premium collected. But IRAs, SEPs, any kind of a retirement fund, you have to trade secured puts. Now, why am I saying this? Well, the potential return based on a cash secured on our screen here is not margin, right? It's based on cash secured. So margin returns would be a lot greater, a lot larger because of that leverage. But again, I'm just kind of giving this so you're aware of it. Today, we're just really going to be talking about that exercise to teach you how to do comparison. Now, let's talk about philosophy. So the naked put strategy in philosophy is less risky than outright ownership. And selling a put, or writing a put, sometimes it's referred to, is about collecting time premium. Now, unless, of course, we sell a put that's in the money, but a conservative trader will choose a strike that is out of the money or below current price. An aggressive trader who is more bullish or potentially wanting to be assigned might choose a strike that is at the money or in the money. And then potential profit would be not only the time premium, but that intrinsic value, how much it's in the money. Now, this means more risk as the trader assumes that the asset moves higher than the strike price. So for today, let's just be conservative, okay? So before we begin our selection process, what we want to start doing is ranking our candidates. And once we choose a candidate, start ranking our strikes and days to expiration. So we're going to look at two factors. One is we're going to look at that highest potential return or potential profit. The second is we're going to look at something called downside protection, or in other words, lower probabilities of being assigned. Now, when we talk about potential returns or annual returns, we want to think about a minimum of a maximum acceptable return, what our maximal profit could be and what we deem as acceptable. Now, most traders use a rule of about 12 to 15% annualized. Now, that is about 1% per every 30 days to expiration. From the probability side of the coin, we're going to look at out of the money probabilities that are greater than 70% and deltas that are lower than 0.30, or the 30 cents or 30%. Now remember our break even percentage. So let me do this. Let's see, let's sort this by, oh, that's interesting. Oh, I see. What's because it's my filter. Let's go back to give us our results. So, for instance, here, look on Apple, what we can see is that if we look at our break-even percentage, the higher that percentage, then the greater the out of the money probability. Now we're going to look at ways to do strike selection, and the thing that we want to do on that is, well, where would I be willing to buy? Now, price does not have to fall or return to that limit. It just needs to stay above, right? And then I will receive that compensation or that income from that time premium. So where am I willing to buy? Now, let's talk about some keys to our selection process. Okay, so let's go back to my screener. And so the first one that I added to is something called overall buy, sell, or hold signal. And notice I've clicked the buy. What this is I remember our strategy is slightly bullish. I want to see technical support. In other words, I want to see bullish support. So if you're not familiar with one of our features on bar chart, if I go to the plus sign here, and you can find this on the actual individual specific chart, equity, you will find a link to find bar chart opinion. But here it says opinion, and what this does is it gives us a breaks down the technical summary of short-term, medium-term, long-term technical indicators, and then an overall percentage. Again, remember, we want to have a stock that is either going to hold value or appreciate. So we're going to get a greater probability of that happening if I have a buy opinion. The other thing that I might look at is I might change my parameters of what I feel is a minimal acceptable return. I could look at, for instance, implied volatility. Now, the theory behind implied volatility is the greater the implied volatility, the pricier the puts become. But there's a caution to here, right? And that would be that those stocks that have, or equities that have very high probabilities, above, let's say, 100, well, that increases the downside risk when we're looking at puts. But again, my rules or my parameters might not be yours, and I don't say mine are the best, right? And they're not all of these are things that you might look, and they're certainly not cut in stone. Now, you could look at implied volatility in another way. You could look at it, for instance, through the lens of IV rank or percentage, if you're familiar with that. Again, there's a webinar that we have on that one. But in general here, again, those that have higher ranks or percentage, you're going to have more pricier puts. But let's go to an example here, and I'm not going to use AA, I'm going to use Verizon. And now Verizon did hop up on the naked put web screener a few times over the last week. And that was because, the implied volatility had gotten high. And now you can see that our percentage in our rank today for Verizon is at the high end of that range. That is telling you that the puts for Verizon are getting pricey, which would mean it would be a good candidate for selling puts. But the volatility, the implied volatility, is only around 25%. Now, in relative, that is high to historical, but 25% versus say another equity that is 50 or 100%, it would be relatively low. And what we will find is that if I go to, let's say, naked puts, and I look at, let's say, 1 month out, or not the weekly, but the monthly expiration, and I start doing that probability potential return, what I might find is that my potential return for me to accept is too close to current price. In other words, our percent bid or our moneyness, right? That brings me more risk that price could fall, and I might have to take ownership of this particular stock. So when we see high ranks but low volatility relative, low potential returns, these are probably better candidates for that discount to entry. In other words, I'm going to sell a put that is closer to current price with the assumption that I'm going to try to get exercise or assigned. And if the stock price goes up, so be it, then I will collect that a minimum acceptable return. Okay. Ooh, mouthful. Let's go back to naked puts. Okay. So now before I enter into any trade, I want to determine where I am wrong, or in other words, where I might exit that trade. Now that could come from a lot of different potential inputs. First of all, is the stock price below where I'm willing to buy? Or is stock price below, let's say, my break-even price? But I think we can also use some technical analysis to help us in determining where we could decide where, first of all, where am I willing to buy, but also where I believe that price won't go below. And if it does go below, then I'm going to exit that trade. All right, so again, let's go back to my screener. And I was kind of looking at these today, and the couple of ones that I think folks are pretty familiar with is Tesla and Nvidia. So let's walk through that process of determining not only where I'm willing to buy, where I think price is not going to, but this is going to help me in my strike selection. So let's do this. Let's go to Tesla first. And here's my chart. And so I did draw some lines prior to starting today's session. And if you're not familiar where you can find, you can find how to do drawing tools. It's very easy to do that. So I did preset some of these to help speed up our process. So let's just do this from a very simple technical analysis of an idea of something called support and resistance. Now, one of the old school things about support and resistance is that old resistance can become new support, or old support can become new resistance. So that could be an area where I might be willing to buy. When price range bounds or is trading in a range, that tends to be an area or a level of support. Or where price originates from a move, or maybe on an acceleration. We're not seeing that here, but an acceleration of price from, in this case, a low, that can also be a level of support. So then we can start thinking about a little bit more advanced technical analysis. And so one that we could use, you come into my bar chart template. Under here we have moving averages, and moving averages act as levels of support and resistance. So this bar chart template gives you the 20 in red, the 50 in blue, the 100 in purple, and the 100 in black. And so the 50 and 200 in black. The 50 and the 200 are really reliable levels of support when we look at technical analysis. So you can see here that the 50-day moving average is in that originally where we found a range of price where we thought there might be some potential support. And 200-day is always a great level of support. Now we can go into even more advanced technical analysis. I don't have a lot of time to go into it. You might have your favorite tool. Now one of the ones that I like is Bollinger Bands, because this is about volatility. And so what I can do is I can add the Bollinger Band study to my chart, and I'm going to look at it two ways. First, I'm going to look at it at the daily level, and that's what we have here. And I'm going to look at what is called the mean. Now, the mean defaults for Bollinger Bands is 20 periods. So if I'm looking at a day, that's a 20-day moving average. We already have that. We already looked at that. But I'll also look at the lower band as a probability that price will not go below there. Now notice how that corresponds closely with our origin of our move, and when we went back to our 200-day moving average, was right in line there. So now what I can say is, where would I be willing to buy, and where would I say that my price might be telling me that I'm wrong, get out. Now I'll also look at the weekly, and on this case, if I'm in an uptrending market, and that's what we kind of want to see when we do this strategy, then we can also use the mean of the weekly Bollinger Band as a level of support. So notice how that falls kind of right in the same relative area. So let's go back to our chart, just our chart. And so we decided that this area is probably a good area where I'm willing to buy. And this area here is an area where I believe that price will not get below. So what do we do from here? So now we're in Tesla. I'm going to go into naked puts, and I'm going to screen on this. And I'm just going to add one element and change one element. So first I'm going to come in here and where it says options information, I'm going to pick the strike price and add that. And I want to find values. Now we looked at this one and we said that somewhere between, I think it was around 225 to around 202 or 203, right? 225 was, excuse me, was this Tesla? Yes, Tesla, 225. 225, excuse me, no, we gotta go in ascending order. To say 205 on the downside where I don't think price will go below, and 225 is right around that area where we had that convergence of our former support level and our 50-day moving average. And then I'm going to come down here on the expiration date, and I'm going to look out 2 monthly expirations. So that would be October, and that would be November. And then I'm going to look at those results. Then I'm going to come over here and sort by strike. And so now what I can do is I can do that process of looking at the potential return and the out of the money probability. So let's look at the low end of our range where I believe price will not go below. Here's 205. And do I get that minimum potential return? I see a couple of them that are in that line. We just have to make sure that I take into consideration the time to expiration. But here we can see a October 25th option will give us 1.7% return, or 20% over annualized. It has only an 85% probability of finishing in the money, and the stock price currently would have to fall 26.5% until I would probably need to do some type of risk management. So that would probably be a good candidate for our strategy. Now I'm a little bit more aggressive and I'm willing to take on the risk of where I'm willing to buy. For instance, let's look at around 220, right on our 50-day moving average, or in that previous range. Notice that our returns go up. Again, I would have to look at that time to expiration. Now, what I will do is also you got to take that moment to think about dividends and earnings. Now, just because it says NA doesn't mean that they don't pay dividends on some stocks. It just means that they probably haven't set the dividend date. But I'm more concerned about earnings, right? Because we know earnings is a catalyst to price movement. And so we can see that, these options here, the November ones and this October 25th one that we kind of located, comes after earnings. So I am going to take on risk of earnings in this particular trade. Okay. All right, so let's go back to our screener. and look at our results. And I think the other one that was in here was NVIDIA, another very popular stock. So let's go to NVIDIA. Again, what's our process? First, we have to decide where we're wrong or where we're willing to buy, and then we're going to do that strike analysis. So again, here is a previous range of price that could be a potential level of support. Here where we've had old support became resistance and then resistance. Now we're above it. That might be too close to current price for me. Where we have an origin of an explosive move is definitely an area of support. If I go to my moving averages, so here we have a confluence of our 50, our 120 day. So that would definitely be a level of support. And notice our 200 day is probably outside of the range of probability. But, again, we never know for sure. But where do we believe that price will not go down to or get below? Well, it looks like somewhere between 107 to 103. And where am I willing to buy? Well, around 115. Again, I'm going to go back to my naked put screener. That is just for NVIDIA. I'm going to screen on it. I'm going to change my filters. I'm going to add my strike. You said 103 on the downside, and 115 is about where I'm willing to buy. Change my expiration to 2 monthlies and look at the results, sort by strike, and then again, I could see if I want to be aggressive, what is the returns that I'm going to get, what are the probabilities based on the time I'm giving my option buyer, and maybe I might give away a little bit of profit to gain a higher probability that I will not get exercise. But again, look at here, we can see, again, that October 25th weekly expiration around 107, which was right at the bottom edge of where we think there was good support. Notice our break even is 105, it's kind of in the middle of that range. Current prices have to fall 16% for us to probably have to exit that trade. But I could get 1.1% over the next whatever that is. I think that would be close to around 30 days. Okay. All right, Gene, I see you've passed along a lot of questions, so let me take a second here, a brief moment to answer some of these questions. And I know one of the things you're going to tell folks is that this screener process, that you have to have a certain type of membership, right, Gene?
That's correct. Our option screeners are part of our bar chart premier membership. And besides the naked put option screener, I mean, we have so many different option strategy screeners out there that you can pick and choose whichever strategy fits your trading style best. If you are not a premier member and you certainly want to try it out, we offer a free 30-day trial, no obligation. I recommend that you take us up on that and look through all these screeners. Again, John mentioned the Options Learning Center. If you're still unsure on some of the strategies, that's a great place to at least get your feet wet and get some ideas as far as how to use a specific strategy and how to best make a good trade using that strategy as well.
Okay, thanks, Gene. All right, so a question here is, if I sell a naked put with a strike price of 100, and the next day the company goes bankrupt, example, Silicon Valley Bank, am I obligated to pay the $10,000 for that strike, which does not exist? Well, first of all, just because a stock goes bankrupt doesn't mean that it doesn't exist. But let's look at this in terms of your obligation. Let's say you are an insurance company and you sold fire insurance to somebody, and that person's house burned down to the ground. You would still be obligated to pay off the insurance, right? You're not relieved of that obligation just because the house does not exist anymore. So no, you would definitely be accountable for that potential $10,000. There's a question about uh, the buy signal. Does that tell us that it's okay to sell naked puts? It's actually the opposite, right? The naked put strategy is a mildly bullish strategy. So what we want to do is we want to eliminate all the stocks that are in downtrends or are neutral. We want to concentrate on those stocks that have bullish technical support. So if I can find a stock that has bullish technical support, that makes for a higher probability that the stock price is going to go up, and that makes for a better naked put candidate. Okay. So Ted asked, what about other technical analysis? I think Ted said something about the Hull moving average. Ted, yeah, if you have a set of tools that you like to help you determine support or resistance, or you feel it helps increases your probability where price will not go to, yeah, though I think that would be fine. So Dan asks, oh, Dan has left. All right, do I look at expirations versus monthlies versus weekly? I think we covered that. So a question about how important is delta? I think we talked about it in terms of a probability. I think is important. You can also use delta, for instance, if you know that your put is going to change by, let's look at, if we're in the case of NVIDIA here, we're looking at the 109 put, and the delta here is 15, almost 16 cents. But, let's say I want to get 1.5% return, and my bid is only worth 145. Well, I could do the math and say, well, if the current price of NVIDIA is trading 122,696, if it fell, let's say $1, then this put would go up by 15 cents or about $1.60. And then I could do the math and say, well, is $1.60 going to get me to that percentage rate? So it's not important in terms of helping us do this ranking and comparison, but it is a tool that I can use that tells me that, hey, I'm going to put in an offer at 160, but I know that I'm probably not going to get filled unless NVIDIA falls to 121.96. So I hope that helps a little bit in your question. I think that is Augustine. So Douglas asks, do you ever buy puts? So that's a totally different strategy, Douglas. We're talking about selling puts, but yes, I definitely will do buy puts to protect my position. So there's a question about lot size, in other words, position sizing. So, again, it really depends upon how much trade equity that you have available. And certainly I would not be putting all of my equity in one put options trade. There is a general rule that most traders do is they will not risk more than 2% on their portfolio on any one trade, or probably don't put more than 5% of their portfolio in terms of their equity into a trade. So you can kind of use that to help you with that measurement. John asked, can I use this strategy to look to very low probability events to kind of generate a consistent amount of income? Yeah, again, Doug, John, that is your prerogative if that's what you want to do. I'm just kind of trying to showing this balance where we can get the maximum profit that we can based on probability. So Wayne asks, is this, yeah, this webinar is definitely for the beginner. Wayne, you know where to find more advanced webinars. I showed in the beginning where you can find that link. Go to our archived Learning Center, our archived webinars, and just type in the word, probably just naked. I think you probably only have to write in. And Wayne, I think there are two or three more advanced naked put strategy webinars. Okay. All right, Gene. I think we're going to end a little early today. That's going to be nice, right? We haven't done that in a while. All right, so next week, let's go up here. Next week, we're going to have a webinar on using the EMAC-D. This is a investment strategy that we have a web page, and there it is, the EMAC buy signal. And I'm going to show you how to use the MACD technical tool in how to generate these buy signals, and then I'm going to give you some kind of trader's insight in terms of, you know, some of these might be good buy signals and some of them might be, well, let's just say maybe we can find some better opportunities. Okay, that is for next week. If I didn't get to all your questions, again, send them to support@barchart.com. And again, I will remind you that if you hadn't a chance to check out our Options Learning Center, that is definitely a new feature that I know that Gene and our crack staff is very supportive of. And I think this is a great jumping off point for those of you who want to learn about options and build that foundation. All right, until next time, folks, the best of health, manage your risk, and the good of all trading.